If you're over 60 and you have money sitting in a bank account right now, I'd like you to pause and watch this entire video because what I'm about to explain is something most retirees in the United States have never had clearly explained to them. Not by their bank, not by a financial professional, and not by the IRS. That information gap quietly costs real people real money and peace of mind every year. There is a federal reporting rule linked to a $10,000 cash threshold that, on the surface, looks simple, but misunderstanding it has led thousands of honest, hard-working people into stressful situations they never expected. They didn't cheat, they didn't hide anything, they simply didn't know how the system actually works. After today, you will. Welcome! If this is your first time here, this channel exists to give you practical information that can help protect you, your family, and your retirement savings. Today's topic is one of the most important we've ever covered, so I encourage you to stay with me from start to finish. I'm going to explain in plain language how this rule functions, why it so often catches innocent retirees off guard, and most importantly, what you can do right now to reduce the risk it ever becomes a problem for you. I'll also share the story of a retired school teacher whose experience really stopped me in my tracks. Not because she did anything wrong, but because her situation shows how easy it is to be treated like a risk when you're just trying to manage your own money. We'll get to her in a few minutes, but first we need a solid foundation. Once you understand the basics, everything else will fall into place. Here are the basics. Under U.S. federal law, banks and similar financial institutions are required to submit a report whenever a cash deposit of more than $10,000 is made in a single business day. That report goes to a bureau of the U.S. Treasury Department called the Financial Crimes Enforcement Network, or FinCEN. The document the bank files is called a Currency Transaction Report, or CTR. And here's the first key point I want you to understand very clearly. The filing of a CTR is not an accusation. It does not automatically mean you are in trouble. It does not mean a criminal investigation has started. And it is not by itself a sign that you did anything wrong. It is simply part of a tracking system, a paper trail. Banks file millions of these reports every year, and in the overwhelming majority of cases, nothing further happens. So if you've made a large cash deposit in the past, and your bank quietly filed one of these reports, that alone is usually nothing to be alarmed about. Where things go wrong is in how many people respond when they find out about the $10,000 reporting rule. Over the years, word about this threshold has spread informally, across family dinner tables, in community conversations, from one well-meaning friend to another. The advice often sounds cautious and smart. Don't ever deposit more than $10,000 in cash. Put $9,000 now and $9,000 next week, and no report will be filed. Have your spouse deposit part at another branch. Keep each deposit just under the limit and you'll stay off the radar. That advice may sound logical. It may sound like it keeps things simple. But here's the hard truth. Deliberately breaking up deposits just to stay under the reporting threshold can be treated as a federal offense. In U.S. law, that pattern is called structuring. And here's the part that surprises most people. The issue is not whether the money itself is legitimate. You could have earned it over 40 years of honest work, reported all of it on your tax return, and saved it carefully. The legal concern is the pattern of trying to avoid the reporting rule, not the origin of the funds. People have had accounts flagged or temporarily frozen, and some have faced civil forfeiture actions because their deposit activity looked like structuring, often without them having any idea that they were creating a problem. They believed they were being cautious. They wanted to avoid hassle. They didn't realize that this kind of pattern is exactly what automated banking systems are designed to detect. Now, you might reasonably think, surely nobody is actively looking for retirees to punish over a couple of deposits. And broadly speaking, federal prosecutors are not targeting retirees as a special group. But the software that screens transactions doesn't know your age, your personal story, or your intentions. It just detects patterns. If it sees several cash deposits, all just under $10,000 over a short period, that sequence can be flagged for human review. At that point, you may be asked to explain what happened or provide documents. That's stressful, time-consuming, and often completely avoidable if you understand the rule in advance. Let's go through 3 common situations where this issue pops up for retirees and what you can do in each case to stay on solid ground. This is general educational information, not individual legal or tax advice. Always consult a qualified professional about your own situation. Scenario 1. Selling something for cash. Maybe you sell an older car, some tools, a piece of equipment, or even a small parcel of land in a private sale. The buyer pays you $11,000 in cash. You go straight to your bank and deposit the entire amount. The bank system automatically generates a CTR and sends it to FinCEN. Your name and the transaction are now part of that federal reporting database. By itself, that is usually fine. The deposit matches the amount you received, and there's a straightforward story. You sold something, you deposited the money. The real trouble often starts after that when someone, trying to help, tells you, next time, don't deposit more than $10,000. Split it up and you'll avoid that report. The next time you have cash, maybe from another sale, you start thinking, I'll put in $8,000 this week and $3,000 next week, just to keep it simple. Now you've taken a clean transaction and turned it into a pattern that can raise questions. The safer approach is actually much simpler. Deposit the full amount at once. If it's $11,000, you deposit $11,000. Yes, the bank will likely file a CTR. That's okay. What really protects you is having documentation. Keep the bill of sale, any title transfer, and your deposit receipt in a folder. If anyone ever asks where the funds came from, which is not common, but it can happen, you have a clear paper trail that matches your banking activity. Scenario 2. Family helping you financially. This situation is emotionally charged because it involves people you care about supporting you. Maybe your child sold a business and wants to give you some of the proceeds. Maybe a daughter wants to help with medical expenses. Maybe a grandchild contributes toward your living costs. Often, as soon as someone mentions the $10,000 rule, the same suggestions appear. I'll wire it to you in smaller chunks. You deposit part, your spouse deposits part. We'll spread it out so the bank doesn't make a fuss. If those amounts and timings are chosen specifically to avoid the reporting threshold, that can be seen as structuring and can potentially draw attention to both the giver and the receiver. What do you do instead? If a family member is providing significant assistance, aim to transfer the funds in a single, clearly documented transaction. A check, a wire, or one cash deposit. If it's a check or wire, there's already a clean record showing where the money came from. If it's cash, go to the bank and deposit the full amount at once. You can mention to the teller that it's a family gift if asked. A simple extra step to keep everything crystal clear is a gift letter. This can be a short, signed and dated note from the person providing the money, stating something like, on date, I gave your name, amount as a personal gift, with no expectation of repayment. Keep that letter with your bank records. Together with your deposit or transfer receipt, it explains the transaction fully and simply. Scenario 3. Consolidating your own savings. This is where Timothy's situation shows how unfair this can feel. Timothy was a retired teacher in her late 60s. After her spouse passed away, she decided to simplify her finances by moving funds from multiple banks into one account. She didn't move everything at once. Over several weeks, she transferred smaller amounts. She wasn't hiding anything, she was overwhelmed and dealing with grief, and smaller steps felt easier to manage. Weeks later, she received a letter from her bank asking her to explain the pattern of deposits. The automated system did not know she was a widow or that she'd saved that money slowly over a lifetime. It only saw repeated deposits under $10,000 in a short time frame and flagged them for review. If you are in a similar position and want to bring your savings together from different accounts, the safer approach is to move the funds in one or a few clear transactions, not many small ones designed to stay below a specific number. Preferably, use a wire transfer or cashier's check from the old institution to the new one. If a bank representative asks about the source, a short, truthful answer is enough. These are my long-term savings being transferred from another bank where I've had an account for many years. For your own records, keep a statement from the original bank showing the balance and outgoing transfer and the confirmation from the receiving bank showing the incoming funds. If the money came from a maturing CD or similar product, keep that notice too. These documents are usually easy to gather and can be invaluable if questions ever arise. Beyond individual situations, think about a broader protection strategy. The single most important thing you can have whenever large sums of money move is a clear explanation on paper of where the money came from and why it moved. A bill of sale, a gift letter, a transfer record, as appropriate. Without documentation, you're relying on your memory and your word. With documentation, you're supported by evidence. In any environment where automated systems and government agencies are involved, clear evidence generally ends conversations much faster than verbal explanations. A second protective layer is a bank statement or report from the source account. Often, the first question in any review is not, "What did you deposit?" but "Where were the funds before this?" If you can show that clearly, there's usually less to discuss. A third layer is your transfer confirmation, your wire receipt, cashier's check stub, or deposit slip. Keep these for at least a few years. They take seconds to file and can prevent long explanations later. A fourth, often overlooked layer is making sure that your tax return and your bank records tell the same story. If you sold property, investments, or other assets and then deposited the money, that sale may need to appear on your tax return depending on your circumstances. When your reported income, gains, and deposits line up, there are fewer open questions. A fifth layer concerns how you respond if someone, a bank or an agency, reaches out with questions. Answer once calmly with your documents in front of you. Provide what is requested, but avoid volunteering unrelated details or calling back repeatedly to add more. If the situation ever feels like more than a routine question, it's wise to pause and speak with a CPA or attorney before providing further explanations. There are three common beliefs that can create a false sense of security. First, if I always stay under $10,000, I'm safe. In reality, multiple deposits at $9,000 or $9,500 over a short period may attract more attention, not less, because it can look like conscious avoidance of the rule. Second, this only happens to people doing something wrong. Automated systems don't know your character. They identify patterns. Entirely honest retirees are reviewed every year, not because they intended harm, but because their activity resembled patterns the software was trained to flag. Third, I'm retired and on a fixed income. Nobody cares about my accounts. The reporting rules don't include age or retirement exemptions. A 74-year-old depositor and a 35-year-old business owner are treated the same by the system. Your protection comes from how clearly your records support your story, not from your age or intentions. The point of this rule is to help identify serious financial crime, things like major money laundering and large-scale tax evasion. It wasn't built to trap everyday retirees who sell a car, accept help from a child, or reorganize accounts after losing a spouse. But because the system can't see your intentions, only your transactions, innocent people can get caught in the net if they unknowingly create patterns that look suspicious. Now you know how the rule actually works. You know that making a large, well-documented deposit is generally safer than trying to stay under the limit. You know that deliberately splitting deposits to avoid reporting can create more risk, not less. And you know that simple documentation, a few key pieces of paper, can make a huge difference if questions ever arise. Here at US Updates Hub, we focus on topics that directly affect your financial security and long-term planning, especially the ones most people assume you already understand. If this video helped clarify something important for you today, please take a moment to like the video. It's free and it signals to the platform that this information may be valuable to others. In the comments, let us know which of the three scenarios feels most relevant to your life right now. Selling property or items, receiving financial help from family, or moving your own savings between accounts. Your experiences and questions help shape the content we create next. And if you haven't subscribed to US Updates Hub yet, now is a good time. In an upcoming video, we'll be covering another retirement-related money topic that very few people explain clearly, but that can directly impact how much you keep in the coming years. This is not financial or legal advice. Always do your own research and consult a qualified professional before making decisions. Hit subscribe and turn on notifications so you don't miss it.